Most people think mortgage renewal is simply about finding the lowest rate. It is not. It is about choosing the kind of risk you can comfortably live with for the next few years. I'm Ahmer. I've spent 20 years in Canadian banking helping customers finding the right financial product that matches their needs, their demands, and their future goals. I'm going through this decision myself right now. I still find the decision confusing. Do I choose fixed? Do I choose variable? Do I stay with my current bank? Do I move the mortgage somewhere else? And how much should I trust anyone's prediction about where interest rates are going? That uncertainty is normal. A mortgage is a large financial commitment. The numbers are important, but the decision also affects your monthly budget, your stress level, and your flexibility. So today, I want to walk through how I'm thinking about my own renewal. This is not personal financial advice. It is simply a practical way to understand the decision. Start with the payment, not the prediction. The first question many people ask is, where are interest rates going? But nobody knows exactly. Economists can make forecasts. Banks can publish outlooks. The Bank of Canada can signal what it is watching. But forecasts change. Instead of trying to predict the perfect rate, I think the better question is, what payment can my household comfortably manage? Look at the payment under each option. Then ask what would happen if groceries cost more, property taxes increased, your car needed repairs, or your income changed. A mortgage payment should not only work during a normal month. It should leave some breathing room for an expensive month. That is why I would start by comparing the actual payments, not just the advertised rates. Fixed is really about certainty. With a fixed rate mortgage, your interest rate normally stays the same for the term you choose. That means your regular payment is predictable. You know what is leaving your account every month. For some people, that certainty is extremely valuable. Maybe your budget is already tight. Maybe you have children, car payments, or other debt. Maybe you are close to retirement and do not want surprises. Or maybe you simply sleep better knowing exactly what your mortgage will cost. There is nothing wrong with paying for predictability. The Bank of Canada has explained that borrowers who want their rates fixed for longer may pay a premium for that peace of mind. But fixed mortgages can also reduce your flexibility. One thing to watch is the penalty if you need to break the mortgage before the term ends. Maybe you plan to sell. Maybe you could move for work. Maybe your family situation could change. The rate matters, but the rules for leaving the mortgage matters too. Before choosing fixed, I would ask, how certain am I that I will keep this mortgage for the full term? It could be 3 years or 5 years or even shorter. Variable is really about uncertainty. With a variable rate mortgage, the interest rate can change during the term. Depending on the mortgage, your payment may change with rates move, or the amount going toward principal may change. That means variable is not simply a bet that rates will fall, it is a decision to accept uncertainty. A lower starting rate can look attractive, but the real question is whether your budget and your emotions can handle changes. Suppose your payment increased. Would it be inconvenient? Or would it create a serious problem for you? That distinction matters. Some people have enough room in their budget to accept the movement. Other people would spend every Bank of Canada announcement worrying about their next payment. A variable mortgage may look good on a spreadsheet, but it still has to work in real life. Something to think about is this. Your ability to accept risk and your willingness to accept risk are not always the same. You may technically be able to afford a higher payment, but you may not want that uncertainty hanging over your household. That is a valid consideration. The term length is another question. Fixed or variable is not the only question. You also need to decide how long you want the mortgage term to be. A shorter term means you will face another renewal sooner. That can give you flexibility if rates change in your favor, but it also means you'll face renewal risk sooner if rates move against you. A longer term gives you more stability, but you may be committed to the product and its conditions for a longer period. The Financial Consumer Agency of Canada notes that shorter terms allow borrowers to renew sooner and potentially take advantage of different rates. but they also expose borrowers to renewal more frequently. I would not choose a term only because someone says rates will be lower next year. I would choose it based on how much certainty and flexibility I need. Should you stay with your bank? Renewal letters are designed to make staying easy. You receive an offer, you sign it, the mortgage continues. There is value in convenience, but convenience should not stop you from asking questions. The current lender already has your mortgage. It knows that switching takes effort. That does not automatically mean its first offer is its best offer. You can ask whether there is a better rate. You can ask about different term lengths. You can ask about prepayment options, penalties, portability, and whether the mortgage is registered in a way that could make switching more complicated. Do not only ask, "What rate can you give me?" Ask, "What are the important conditions attached to this rate?" A slightly lower rate may not be the better mortgage if the product is restrictive or expensive to leave. Should you switch lenders? Changing lenders can be worth exploring, but compare the complete offer. Ask about legal fees, appraisal costs, discharge fees, setup fees, and whether the new lender will cover any of them. Or maybe they're offering cashback. Also compare the mortgage features. How much can you prepay? Can you increase your payments? Can you move the mortgage to another property? How is the penalty calculated if you break it? And are you changing only the lender, or are you also increasing the mortgage balance or extending the amortization? These details can affect the application and qualification process. Recent federal regulatory changes have made some straightforward mortgage switches easier. For certain uninsured mortgages, moving between federally regulated lenders, the minimum qualifying rate is not expected to apply when neither the loan amount nor the amortization is increased. But every situation is different, and the new lender will still review the application and decide whether it fits its requirements. From a banking perspective, the lender is looking at more than your mortgage rate. It may review your income, existing debt, credit history, property, payment record, and the overall affordability of the mortgage. So start the conversation before the final few days. Give yourself enough time to compare options without feeling rushed. My mortgage renewal checklist. Here are the questions I'm asking myself. First, what payment works comfortably within my budget? Not the maximum payment I could survive. The payment that still leaves room for normal life. Second, how would I feel if the payment changed? Could I manage it financially? Could I manage it emotionally? Third, how likely am I to sell, move, refinance, or make a major change before the term ends? Fourth, what is the cost of leaving the mortgage early? Fifth, what features am I receiving beyond the interest rate? And finally, am I choosing based on my situation, or am I making a rushed prediction about interest rates? These questions do not produce one perfect answer, but they make the decision clearer. My personal reflection: after 20 years around banking, I have learned that knowledge does not remove every uncertainty. Sometimes knowledge makes you more aware of how many variables exist. Rates can change, family situations can change, income can change, housing plans can change. The goal is not to predict every possibility. The goal is to choose an option that your household can manage even if things do not unfold exactly as expected. I wish mortgage renewals were explained this way more often. Many Canadians are not careless with money. They are being asked to make a complicated decision while comparing rates, payments, penalties, forecasts, and sales offers. Feeling unsure does not mean you are bad with money. It means the decision deserves proper attention. My biggest takeaway is this: do not choose a mortgage only by asking which option could cost the least. Ask which option gives you the right balance of cost, certainty, flexibility, and breathing room. That is the mortgage you are more likely to live with comfortably. So, what part of mortgage renewal is confusing you most right now? Choosing fixed or variable, deciding on the term, or knowing whether to switch lenders?